What's up, James?
How are you doing?
I'm doing well. Have you ever been happy to get a surgery?
No.
I don't think most people are happy, but I have a weird situation where I was really happy about the thought of getting surgery because I thought it would fix all of my problems. I went to physical therapy, I got an MRI that said this diagnosis. I went to so many doctors. No one told me what to do. So at one point, I was like, look, just open me up and just fix me. I'm in that much agony because of my hip, because I play soccer too much and I love it. And that's another episode. But I'll see people come to me, and I'm sure you've seen it as well, where they go, James, just tell me, what Roth conversion do I do? Is it the 22% bracket? Well, it's going to become 25. So I don't know. What bracket do I do? They're conversion happy. And they just want to do a conversion because they think it's going to fix all of their problems in the same way I thought surgery would fix all of my problems. But before you do surgery, there are things we should look at. And so I want to talk to you today about when it does and does not make sense to do these Roth conversions.
I like that analogy because it is like surgery because people don't realize this. Roth conversions are painful up front in the same way surgery can be painful up front. And I mean that because what you're doing in the Roth conversion is you're saying, I'm going to pay more taxes today so that I don't have to pay as much in the future. I'm going to pay taxes today at a lower rate so that I don't have to pay them in the future at a higher rate. Kind of like surgery. I'm going to go through the pain today so I can continue playing soccer and have this quality of life in the future. But perfect analogy. Where should we start with this? Because to your point, people just say, open me up, do
Yeah.
surgery, do the conversions. Not always the right approach.
Let's start with the two people that deserve to get credit. And as I bring this up on my screen, um, can you share with everyone who have not seen the last few episodes who the heck we are? We're doing this together. We have separate shows, and I'll pull this up.
Yes, I'm James. This is Ari. We work together with a lot of people did not know. Ari has a podcast channel and a YouTube channel. I have a podcast channel and a YouTube channel. If you're on YouTube, you're watching this on my channel. If you're listening, you might be listening on Ari's early retirement podcast, or you might be listening on my Ready for Retirement podcast because we're going to take the audio content and push it to both those places. But we said, hey, we've been doing this for several years together now, separate channels. People are surprised sometimes when they say, oh, you're actually working together. We say, yes. So let's actually do a podcast episode where we get to banter back and forth about different things, not just about things that we want to banter about, but about comments we're getting on our YouTube videos, feedback we're getting from people listening so that we can answer a lot of the questions that many of you have.
Awesome. I'm going to steal one line that I believe it was your dad told you. And you said, your job as an advisor is not just to advise, but teach people how to think, how to organize their brain. And so my hope is for some of you, as you take away from this episode today, wow, I should never do a Roth conversion. And anytime I see someone bring it up online or a neighbor or coworker use this fancy conversion word, I'll get to go, I don't have to worry about it. And others of you are going to be like, wow, this is going to really change how much I can spend in retirement and legacy goals and yada, yada. So here are the two people that get credit for today's episode. Once again, if you have a comment that you want to leave, you want a question for us to address, please drop it in the comments and we will look to answer that in a future episode. So this comes from Linda Pipkins 4592. When is the best time to perform Roth conversions for a couple who is 64 and 60 with a pre-tax retirement value of $2.5 million? Also, how much per year? Well, James, this is an easy answer. Always February 10th. Like, how does this person not know? No, it's not February 10th. So, guys, that is the first question. The second question for this is coming from Thunder Snow. And I just picked this because that's a cool username.
That is
Thunder
a cool
Snow.
username.
You like that username?
I'm following Thunder Snow, whatever they're doing. Yeah, that's great.
Thunder Snow, that's the new name of our show. Do you have to be working to do a Roth conversion or can it be done after retirement? I can see how the biggest hesitation in doing a conversion is that you're guaranteeing that you'll pay taxes up front since you don't know what brackets will be in the future. What do we think of these questions?
Good questions. And I think that these questions with Roth conversions in general, there's this thought that, okay, there's a pretty quick answer to this. Whereas the reality is it depends on so many things. The question is why? Why are we doing Roth conversions? Which for a lot of people may sound ridiculous. Like there's only one reason why, but it's not. Hey, some people do Roth conversions for themselves of how can I keep my lifetime tax bracket as low as possible. Some people do tax brackets for potentially a surviving spouse. If they know, hey, my health is not bad. I've got a younger spouse. And I'm just speaking hypothetically, my health's fine, but I've got a younger spouse. And if I pass away, they're going to have single tax brackets as opposed to married filing jointly. They're going to require distributions, going to push them way up to the top of that. I need to avoid that. Others do it for their kids. Of we actually don't need these assets, but we don't want our kids to have to inherit them and then be forced to distribute all their pre-tax account balances at a time that probably corresponds with their own peak earning years. We want this to be part of our estate plan or our transition plan, even to. So understanding why you're doing it is key, because then you can look at, I guess I should say it this way. My first thing, Ari, is when someone says, how much should I do a Roth conversion? Before answering, I first want to start with, why should you not do a Roth conversion? I want to see, is there any way we can prevent you from paying taxes up front, from eating your cauliflower up front, like you talk about? And if there is, great. But sometimes we do the analysis, we do everything. We say, no, as much as it is going to hurt to write that check now, it's going to hurt a whole heck of a lot more than it will be to wait and do nothing and write a check for 2 times, 3 times the amount in the future.
I like that. Not going straight to surgery. When should we not do this? When should someone not do this? What are those simple things to first consider before going straight to surgery?
First thing is you're going to be in a lower tax bracket in the future. So I'll bring up a recent example. I was talking with someone. Someone was working. They were 61 years old. This was a client. They were going to move to Texas when they retired. They were living in California today. They were working, and this is a little different. They were really prioritizing doing Roth contributions to their 401k. So we'll tie this to the conversion piece now. They were working at a high income. They said, we really want to have a tax efficient retirement. And they're putting all their 401k into the Roth 401k. And we looked at it and we said, look, when you retire, your income is going to go way down because you're not going to be making this high 6-figure job income anymore. Plus, when you retire, you're paying 9-10% in California state taxes today. You're moving to Texas, and that state tax bracket will go away. So why are we paying into something? Why are we contributing to a Roth account, which gives no tax benefits today, just so we can pull it out in the future when we're going to be in a lower tax bracket? It's the opposite of what we should be doing. We should be saving money on taxes on the contribution and then pulling it out in the future. So if you're in a position today where you're in a higher tax bracket now than you will be in the future, a Roth conversion doesn't really make sense. Now you have to think through marginal tax bracket versus effective tax bracket, and there's some nuance to that. But if you're not going to be in a higher tax bracket, some of this we don't really know because who knows where tax brackets are in 10, 15, 20 years. But that would be a good reason not to. Another good reason not to, and I don't want to take the whole show to talk about this, but I think this is important. If you're charitably inclined, there's something called a qualified charitable distribution. I was talking to a client one time and he said, hey, I'm selling my business and I think we should, take the proceeds, put it into a flip CRUT, an IMCRUT, all this. I think it is really sophisticated tax plan, use a donor advised fund as the beneficiary of this. So, well, you really want to gift a lot of money, which is incredible. Why don't, instead of this big complicated estate transaction that's going to cost you a lot of money in attorney fees and be a lot to administer, what if we just treat your 401k like your donor advised fund, like your giving account? From the standpoint of you can gift up to $100,000 per year from that directly to a charity via what's called a qualified charitable distribution. And that money is never taxable to you. You just gift it right from your IRA as opposed to being forced to distribute it. The bottom line is, though, the third reason I'll say is the main thing that prompts the need for Roth conversions is this thing called required minimum distributions, which is you might look at your income in the future and say, okay, well, I got Social Security, I've got a pension, I've got a little bit of income from investments. I'm probably going to be in a lower tax bracket, at least than I am now. That may be true until you factor in these required distributions, where if you've done a good job of saving and investing 2 pre-tax accounts, the IRS is going to say, congratulations, you are now required to take minimum amounts out of that each year, and that number grows. And so even if you're not, I guess, discretionary spending that money, there's going to be some required spending of that, which could then push you into a higher tax bracket, prompting the need for Roth conversions today. But if you're not going to have a significant RMD issue, that might be another reason not to. So before I ramble on too long, I'm going to turn it back to you to regain control over the show.
Okay, best example on required minimum distributions. This is the first year I was working with you, James. We were in the little office together in Solana Beach. And if you remember the name of the client, you can say it. I don't know if we're allowed and all that, but if we're allowed to say the name, he said, James, do you know how I know I'm doing well? You're like, I don't know. And he said, it's when I know I have required minimum distributions beyond what I'm going to need. And I remember both of us looking at each other a little bit and being like, oh, that's a cool definition. Do you remember what client that was by
No, I
chance?
don't. I don't remember that. I'm sure it
So I
happened.
remember I remember so clearly. So the client was like, here we are, I'm sure excited to begin discussing with clients because, in person back then. And now we do a lot of our work, literally all of our work virtually through Zoom. And I remember him saying, hey guys, I get we're going to talk about Roth conversions and I get that I need to do it. I'm not saying I don't want to do it. I'm saying I know I'm in a good position financially when I need to take out more than I'll ever need. So yeah, there's a problem, but there's a good problem. I remember for
Oh, I know who
me.
you're talking about. Yeah.
Okay.
Yeah, yeah, yeah. It's coming back now. Yep.
Okay. You can say his
Sorry,
name
go
if
ahead.
you want. If you don't want to, you don't have to. But um, it made me think of a few things. So I had one couple I spoke to, and I said, "How much do you want to spend?" And they go, "We'd love to spend 8,000 a month in retirement." I said, "Okay. What if I told you had to spend 10,000 a month?" They go, "Well, that sounds cool too." I go, "What about 12,000 a month?" They go, "Oh yeah, we could definitely do that." I go, "Okay, so this number is moving pretty quickly here." I said, "What about 20,000 a month?" They go, "I don't know if I could spend that amount." I go, "What if I forced you to?" And they're like, well, I mean, I guess we could do it, but I just don't think we'd really need to. Like, that wouldn't add to our quality of life. And I said, well, then great. Maybe we shouldn't do Roth conversions. And they're like, what do you mean? I thought you told me just a second ago, we have to do it. You have this whole thing about your no brainer bracket and you fill up the next bracket. And I said, yeah, but a real easy fix to decreasing the need to do Roth conversions is spending more money. And you just told me you want to spend 8,000 a month. And then in the span of about 6 seconds, you are willing to spend 12,000 a month. So we need to really determine how much you'd love to spend. And you can spend more, and there's less of a need to do a Roth conversion. So fix number one that I see as easy is spend more money. Fix number two that I see is easy, retire earlier. I don't want someone to retire too early and run the risk of running out. But we also, as a true fiduciary, our role is to go, got it. What is the true goal of the client? Can we act in their best interest? Sometimes acting in their best interest is saying, look, you told me that you have health conditions and that you don't know how long you're going to be in this state of mind. And I'm not saying this is you, James, or any of you listening right now, but I'll joke that I'm the meanest advisor. I'm not actually mean. Okay. I'm just transparent. And the reason I say that is because some people, just like this couple here, if I go back and share this screen just for this example here, they are literally asking, when is the best time to do Roth conversions? I already told them it's February 12th, but they didn't hear me. So now, when is the best time for a couple 64 and 60 with 2.5 million? How much per year? Hey, when do you want to stop working? Hey, how much do you really want to spend? Any thoughts?
Yeah, I think that, big picture thought, then I'm gonna come back to this,
Okay.
is this might have been you, this might have been someone else. Someone was saying, "Hey, Roth conversion is kinda like a buzzword today. Roth conversion is
Mm,
kinda bad today." And it's like, yeah, I can see what they mean by that. Of everyone, to your point, is Roth conversion happy? And I think that that can be a problem when people think that the sign of a successful financial plan is the Roth conversion strategy that saves you the most amount of money. I mean, how do you gauge the success of your tax strategy? Well, if I can show you that this strategy saves you $2 million and this one saves you one, obviously the one with $2 million savings is better, right? You would think that. But you then go back to, well, what does that mean? That means you're decreasing your personal spending already in retirement so that you can keep your tax bracket super low so that you can free up more space in the tax brackets we want to fill up so that we can do more Roth conversion. So don't take that trip. Don't spend time going to those shows with your wife. Don't do the things that you want to do because I can save you $2 million in taxes instead of 1 million. Well, that's the worst advice in the world. We got to remember what the main goal here is. We got to keep the main thing, and the main thing is not tax savings. The main thing is live the life you want to live. We talk about our mission of helping people get the most out of life with their money, not necessarily just maximizing money for the sake of maximizing money. And once you fully optimized your life, then let's maximize the tax savings that can be maximized from there. But if all you're looking at is a Roth conversion piece, the best way to optimize that is to minimize your quality of life, minimize your own spending. So I forget what your actual question was, but I just wanted to tie that in because this should never be the primary thing. This should be a secondary thing. And even going back to our process with clients, so where does it start? We'll talk about purpose. What do you want to do? What's important to you? Then the next step is the income plan to maximize income to support that. Then the next step is the investment strategy to fully support that. Then finally, we'll talk about taxes because that's not the first domino. It's not even the second domino to fall. It's okay, once these other things have been optimized, it's the order of operations by which you look at things. Taxes are super important, but do not ever let it become the main thing.
I definitely think going through a brief financial example would help people understand if they should worry about conversions. So let's take this couple, Linda Pipkins. They've got 2.5 million bucks, and they said they're 64 and 60. Well, let's assume that RMDs for them begin at 75, and let's just assume their investments do really well and it doubles. And let's just assume from 2.5 million to 5 million bucks, 75. So call it 11 years and 15 years later, they've now got 5 million bucks. And let's assume they didn't do any conversions. They never heard us do any episode. They don't want to eat any cauliflower. Well, they've now got 5 million bucks at 75 in
Yeah.
pre-tax accounts. They also have Social Security. I have no idea if they have rental income or inheritance, but let's just assume Social Security and 5 million bucks pre-tax. And correct me if I'm wrong here because I might not recall, but is it 3.8% that
Starts
RMDs?
in the high threes. Let's round up to
Okay.
4. So by like age 76, 77, more somewhere around there, your required is based upon life expectancy, and there's a table that the IRS uses, but call it 4% is the amount that you have to take out of your portfolio.
Okay.
That's $200,000, and
Plus
that's
Social Security.
stacking on top of Social Security. And by the way, if you have $2.5 million in your 401k today in your early 60s, it means you've done pretty well. You probably have some brokerage assets as well. You maybe have some real estate assets. You maybe acquire some other things that will generate taxable income. So it's not just this 200,000 required distribution, which by the way, will continue to go up each year in terms of how much you have to take out. It's Social Security plus dividends and interest plus anything else you have plus that. And so what you're doing is you're saying, okay, what will our tax bracket be in the future? And no, we don't know where tax rates are going to be. No, we don't know exactly what's going to happen. But a a projection that's approximately right is way better than being precisely wrong, which is doing nothing. What tax bracket are we in today? And then compare the two. And if it's a much higher bracket in the future, consider a conversion today. Now, the caveat to that is if today you're still working, it's not just looking at today in the future, it's also looking at the in between years. Today, for example, if you're in the 22% bracket, and in the future you might be in the 32% bracket, you might jump to the conclusion, I should do a conversion. Well, maybe, but what if the next 10 years you're in the 0% bracket because you retire and you're living on brokerage accounts or whatever? So, not to get too in depth, but look at the 30,000-foot view of what is my marginal tax bracket expected to be each and every year, assuming no conversions, so that I know what year should I fill up what tax brackets to normalize or even out where I'm paying the taxes, and in doing so, potentially save a whole lot of money in
This might
taxes.
be a longer episode because we just love this stuff, but I wanna touch on briefly IRMA, not for too long, but some people don't even know what IRMA is, so I just wanna allude to it because some people make the mistake of going, "Oh my gosh, I'm not gonna do Roth conversions. That's gonna increase my income," and then there's this IRMA thing, but I don't know if you're talking about a hurricane or if that's something else, like, what am I missing here? So, wanna allude to that, but at the same time, I want to bring up a huge point that you just said, which is, okay, we have a tax window. If we retire at 65 and Social Security doesn't begin until 70, and then RMDs don't begin until 75, well, to answer this, one of the questions here is, do you have to be working to do a conversion? Can it be done after? You can do it at any time. Doesn't mean you should do it, but you can. What
That
we want
I
to
wanna stop
determine
real quick on
is,
that point.
yeah,
That's an excellent
please,
point because a lot of people think, "Oh, you have to be working to make a Roth contribution." That is true.
interrupt.
You have to have earned income to make a contribution. You can make a conversion whenever. Whether you're working, not working, it typically makes more sense when you're not working because income's lower, but you can do it whenever.
Good interruption. Please keep doing that. This on my screen, you can see here, this is an example of someone who is in retirement, and you can see this is IRMA brackets. Now, some of you are like, I don't even know what you're talking about right now. Is that like your aunt? Not my aunt. James, do you mind breaking down what the heck IRMA means when people should or should not worry about this?
Yeah, IRMA is, a Medicare premium or like a not a premium, it's a surcharge to your premium. So when you get Medicare, there's just a cost for your Part B premium. So for this year, it's $174.70. That's the 2024 number. Now, that goes up as your income goes up. So you can see if you're watching on YouTube, you can see this. If you're listening on podcasts, mine or Ari's, check it out on YouTube. James Knoll's the podcast or the YouTube channel this is on. You can see the numbers Ari showing here. Um, Once your modified adjusted gross income exceeds, these are 2024 numbers, 206,000 if you're married, half of that if you're single, there's a premium adjustment. You're paying an extra $70 for your Part B, Medicare Part B, an extra $13 for your Medicare Part D. Those are monthly amounts, so an extra $83 per month. As your income continues to go up, those surcharges go up. So it's not technically a tax in the standpoint like an income tax is of once your income goes over certain thresholds, you move from the 10% bracket to 12% bracket, 12% to 22%, so on and so forth. But it should be viewed as like a tax because the more your income goes up, it's not just your federal income taxes that you're paying more on or your state income taxes. There's also potentially Medicare premium surcharges. I will say people sometimes get too hung up on this. They think, oh, I don't want to do a conversion because of the IRMA surcharge. One way of thinking about it is the top of the 22% federal income tax bracket somewhat corresponds with the top of the first uh, the threshold at which IRMA kicks in. IRMA kicks in if you're married, was it 206,000, 203,000? Yeah,
2-6.
206,000 and above is when the first IRMA surcharge kicks in. The top of the 22% bracket for married filing jointly is $201,050. Divide those numbers in half if you want for single. So if you're just converting up to top of the 22% bracket each time, you're not crossing that threshold. The thing to be mindful of, and this is where we're probably going to lose people and it gets confusing, and I get that, is one is measuring your taxable income. One is measuring your adjusted gross income, your modified adjusted gross income. So that's where it's a little bit more technical than is going to work out to describe on a podcast episode, but do your tax prep when you do this because
I
they're
have a
both
good one
important.
for that. Yeah, so that's the equivalent of when I went to go get a surgery that I ended up not getting, and I'll do a separate episode on that in the future if you guys really wanna know, which you guys can let me know in the comments if you care or not. I won't be offended either way. But we were debating which part of my hip should we attack from? Is it from the back of the hip? Is it the front? What's gonna create more scar tissue? There's a level of this where when I go to my surgeon, I'm deferring to him who's seen the inside of hips and what creates most scar tissue. So the risk to this, in the same example you just shared there, James, of modified adjusted gross income versus taxable income, some people, they know enough to be dangerous. And a lot of you guys listening are trying to optimize your financial strategy. So we're not mad at you, but you'll often say, oh my gosh, I'm retired. I'm 63. I'm going to go do a Roth conversion. And then 2 years later, you get all mad at me. And I'm like, hey, what's going on? And you're like, you didn't tell me about this 2-year look back thing, and that impacts my Medicare and my this and my that. There's so many different things. James and I try to pick and choose what's going to be the most bang for your buck in these episodes. So not going through every single thing there, but I hear you.
Yeah, and I'm googling as we speak. There's a form you can actually file um, to say like there is a 2-year look back, which is how it's calculated. You can go tell Social Security, look, my income for this, for example, if your income 2 years ago was $300,000 and you're turning 65, you're going to have an IRMA surcharge on your Medicare payments this year, unless you proactively go to Social Security. I'm trying to look up the form as we speak.
Me too.
SSA-44, I believe it is, where you can say, look, that was 2 years ago. And so you're exactly right. You can be proactive about it, which is a great thing to do to say this year it's actually only going to be 100,000. So that surcharge shouldn't apply. But yes, that's that you got to keep both in mind.
Awesome. I know we have to pick and choose our moments, and we're already at 24, 25 minutes in here. Regarding Roth conversions, any last things you want to leave people with regarding legacy? When can people do those QCDs you were talking about?
QCDs you can start doing as soon as age 70 and a half. Required distributions start at age 73 or 75, depending on your birth year. It used to be 72. Before that used to be 70 and a half. There's a lot. I think that the main thing, like we talked about, Ari, is before just jumping into them, because it seems like there's almost this weirdly dopamine hit. If I'm doing something proactive, I'm getting the surgery and thinking it's going to be okay. Make sure it's the right thing to do. There's a lot of cases where it's not. Someone that has I don't know, when required minimum distributions aren't going to be an issue. Like I just see too many people convert too much upfront. It's like you probably would have been fine with either no conversions or just at least a lesser amount. There's another thing called a Social Security tax torpedo, where the way Social Security is taxed is um, it's based on what's called your provisional income. And as your taxable income increases or as your provisional income increases, more and more of your Social Security benefit gets pulled into your taxable income calculation. And so what happens is you could be in the 12% bracket, but there's this Social Security tax torpedo zone where I got a video I'll try to link in the show notes here where I walk through this probably with way more clarity than I'm describing it here. Not only are you doing a Roth conversion at the 12% bracket, which seems like a no-brainer, but you're also pulling more of your Social Security into your taxable income and then paying tax on that too. And you're effectively paying a 22.2% tax, I believe it is, as opposed to just 12% federally. So the main thing is really make sure it's the right thing. For many people, it's absolutely the right thing. It's a no-brainer. You should 100% do it. I just see too many people where it's not, and they waste money when it wasn't required.
Love it. I'll leave you all with, unless James, you have anything you want to chime in after this, with the cauliflower example, which I share a lot. I don't have the shirt on me, but it's one of my favorite gifts I've received, where I'll explain a conversion like eating cauliflower. I want you to eat a little bit of vegetables today to avoid having to eat a ton of cauliflower in the future. And I don't want any of you guys to be going, oh my gosh, my whole retirement, I'm going to eat so much vegetables, which is paying a lot in taxes. Now, some of you are like, I like cauliflower. This is a terrible example. Tell me which vegetable you'd prefer. And next time, maybe next episode, James, I'll whip out the shirt so everyone gets to see it. But that's all I've got on conversions.
That's it. Yeah. You may have shared this, but when you proposed to Alice, we sent Alice a big bouquet of roses and Ari a big bouquet of cauliflower. And I don't know if you ever ate it, but you got it. But yeah, eat
We
your
got some
cauliflower when it
legendary
makes
things.
sense.
Yeah.
Avoid it when it doesn't.
Yeah. That's my best man at the wedding. It's gonna be the cauliflower.
Love it. Well, cool. All right. That's all I got. Anything else from you?
Nope, that's it. See you
Okay,
next time.
last thing I'll say is,
Yes.
this is being posted on my YouTube channel, just so people aren't confused. Ari has a podcast, early retirement podcast. We'll have a link out to that. Make sure you listen there. I had the podcast, the Ready for Retirement podcast. We'll link out there. We both have been working together for a very long time. Different shows. People had no idea we worked together, so we're now doing this together and wanted to make sure that people that know me also know Ari and vice versa. So we are good. We'll have links to that, and we'll see you all next time.
Love you guys.
The information presented is for educational purposes only and is not intended as an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and are not guaranteed. Any mention of rates of return are historical and illustrative in nature and are not a guarantee of future returns. Past performance does not guarantee future performance.
Viewers are encouraged to seek advice from a qualified tax, legal, or investment advisor professional to determine whether any information presented may be suitable for their specific situation.
Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.